Order, order. Welcome to the Treasury Select Committee on Tuesday, the 22nd of July 2025. Today we're pleased to have in front of us the Governor of the Bank of England, Andrew Bailey, who's joined by two members of the Financial Policy Committee, two external members, Professor Randall Kroszner and Carolyn Wilkins. And we're here to talk about the Bank of England's Financial Stability Report, which came out this month. I think I just wanted to really kick off with you, if I may, Governor, about what your, any concerns you have generally about financial stability, obviously, around the report, but particularly what is your concern about the cost of borrowing at the moment, because obviously that's going up, and how do you think that's affecting financial stability?
Well, I think you're probably referring to movements in bond yields, particularly over the course of this year. So I think the first thing I'd say is that we've seen an increase in term premia in government bond markets, by which what I mean is that yield curves have steepened, so the cost of borrowing at longer term has increased. Hasn't really increased at the sort of short end, because that's pinned down by monetary policy, so that's determined by monetary policy. But we have seen steepening of yield curves going on. Now, I think the important thing to say is that is a global phenomenon. It's not in any sense unique to this country. In fact, the pattern in this country is not in any sense out of line with what we've seen in other markets, and we've seen steeper increases in some other markets. So what are the causes of that? Well, in the short run, I think it is greater uncertainty, clearly. On two fronts, really, I would say. One is obviously uncertainty around exactly what's going on in sort of trade policy at the moment, and the uncertainty that's created. The second thing is uncertainty globally around fiscal policy, and that's again a global phenomenon. What I would say there is that actually, if you put it into a somewhat longer-term context, so look over the last decade, for instance. One of the big shifts that we've seen in the landscape has been a shift in many countries, and this country is true of this, towards greater government borrowing. But actually that, on the other side of if you like, the balance sheet, in terms of the private sector, and here I mean both households and corporates, debt levels actually have been the increase in debt levels has been much more subdued. So we've seen this sort of shift in the balance of borrowing. Now, that is a reflection of sort of challenges in fiscal policy and sort of deliberate directions in fiscal policy. And I think that uncertainty around the direction of fiscal policy is having some effect on term premia as well in bond markets. Again, it's a global phenomenon, though.
You sound sort of unconcerned. I mean, is that a fair characterisation, or is it just the Governor of the Bank of England always has to be unconcerned?
I mean, it's reflective of conditions. Now, those two conditions are, one is much greater uncertainty around geopolitics and trade policy, and the other one is a general trend and pressure on fiscal policy in many countries, I would say.
Okay. Well, I mean, we could talk about that a lot more, but I wanted to really turn to Professor Kroszner and Carolyn Wilkins as external members of the committee. We've had a lot of discussion about regulatory change, and the Chancellor made those points again at the Mansion House speech with her Leeds reforms. Do you have any red lines as individuals and members of the committee about where you would want to see on regulatory change? Professor Kroszner.
Well, it's certainly very important to make sure that we maintain resilience in the financial system. That's fundamental. That is the key remit, the prime goal of the Financial Policy Committee. So certainly anything that we would, or at least from my perspective, I can't speak for others, that would challenge the resilience of the financial system would be a red line. But I don't have any particulars that I have
no concrete examples,
but no concrete examples. But that certainly that's our remit. That's what we need to do, and extremely important that we continue to maintain financial stability, because that's fundamental to economic growth. We saw that during the global financial crisis. If you don't have financial stability, it's going to be a major challenge to have economic growth.
Indeed. What about you, Ms. Wilkins?
I share the same support for the financial stability mandate, and at the same time I realize that a lot of the reforms that we did post the GFC have stood us in very good stead. We've seen that given the stresses that the banking system, not only in the UK but elsewhere, has come under over the past few years. At the same time, we also know, with all humility, that it's not perfect. And there are ways that we can look at those regulations and maybe simplify them, maybe alter them in some way, and still achieve a very good financial stability outcome with more efficiency. And so I think part of our work that we're focused on is just exactly how to do that specifically in a way that really does serve the growth agenda.
Could you talk us through how you monitor as a committee that change? So you're saying, we had the changes after the financial crisis. As you say, nothing's ever perfect, is it? But that overall change, and monitoring that overall change, and how that has an impact, how the regulatory reform has an impact on stability. What are you looking at when you're in committee or you're preparing for it to make that judgment? And obviously your experience from Canada is probably quite relevant here.
Well, I think it depends on what aspect of regulation you're looking at, and so I can give you a couple of examples quickly.
Yep.
One example that I think is very recent and relevant is the changes that we made to the affordability guidance that we had given with respect to the add-on to the interest rate, so that people could afford, their debt service ratio wouldn't be too high if interest rates increased, say, by 300 basis points relative to the contractual reference rate. At the same time, we had a loan-to-income, or we have a loan-to-income flow limit of 15%, and the question was, well, after a few years, can we do some analytical research to see where are they binding and are they both needed? And because we had the data and the experience, and as you know well, we realized that in fact we didn't need them both. We thought we could achieve the same financial stability outcome with the FCA's own affordability limit, and so we made changes there. Same with another change with the LTI that we've done in the last FSR, in the last committee meeting. On the capital side, there's stress tests. And so, again, those are checks on the levels of capital, the buffers that are there. So there's different mechanisms. And I think having been at the Bank of Canada and looked at other central banks, the Bank of England is quite good at their modeling and really ambitious in terms of their data collection to take this kind of analytics seriously.
Okay, so you're leaning into the data and that analytics very heavily. Professor Kroszner, anything to add?
That's exactly right. I mean, I think one of the things that was very attractive to me about when I was very honored to be asked to be considered to be part of the committee is that the Bank of England takes cost benefit very seriously, and I think that's something where we do dive into the data, we do the analytics, and try to think about what's the best way to achieve the outcome, which of course is as Carolyn had said, never perfect. But we try to reassess, just like we had done with the mortgage affordability issues, put out a rule, gather the data, assess, is there a more effective way to assure that we get the goal that we want at the least cost?
Okay, and obviously we have the Chancellor making her Mansion House speech, leaning into the previous pledges she'd made, now called the Leeds reforms. If I go first to you, Professor Kroszner, are there any elements of those reforms that worry you, make you nervous? I mean, in terms of financial stability, and if so, how are you pushing back or making judgments about how to implement those?
Sure. So I think there are a lot of different issues that have arisen, and basically we use the same sort of focus that I was mentioning from before. We sort of look at the costs and benefits. We take the financial stability remit very, very seriously, and I at least so far, in the way in which they've been proposed in a general sense, I don't see a necessary clash between financial stability and some of those reforms, but always the devil is in the details. Exactly how do you do it? If you reform capital, if you reform liquidity, those can be reasonable reforms, or they can be ones that face a lot of challenges. One of the biggest challenges we have is in the post-crisis period. A lot of activities have moved outside of the traditional banking sector. That's both an intended and unintended consequence of the post-crisis reforms. You wanted some risky things not to be done by banks, but just because the banks aren't doing it doesn't mean that no one's doing it. And so that's one of the reasons why the committee has really focused on the non-bank sector to make sure that you're not just getting a migration of risk to an area that's less transparent.
Okay, Ms. Wilkins.
I would have said something very similar to that, and so to save time, I would just add that aside from the non-bank financial sector, the other area that I think is really important for innovation and growth are new areas like AI, like stable coins, other forms of digitalization where hard choices need to be made about our risk appetite, where the risks to financial stability actually lie, and how do we get our arms around that and have the right safeguards while at the same time not inordinately getting in the way of what might be a very productive innovation.
Thank you. John Grady, MP.
Just quickly, Professor Kroszner, you mentioned the non-bank financial sector, and that's something that features prominently in the report.
Yes.
Are you confident that the bank has got the right tools to get information on what's going on in that sector? And are you confident that at the moment it's adequately regulated from a stability point of view?
So one of the things that the Financial Policy Committee has done the so-called the SWES. I had been at the Federal Reserve, and I didn't think there was any institution that could possibly have more acronyms than the Fed. But the Bank of England makes the U.S. Federal Reserve look like very simple on that. So this was to try to look at exactly this sector, and it was really the first work that has been done to try to look systematically at the non-bank sector. And so we're still learning. And so I don't think I have a final answer to you yet on what other tools we might need. But it was a really valuable first step that now a lot of other countries are following. I actually gave my first speech as an FPC member on exactly this issue, that the U.S. should be doing something like this, and they're starting to explore these issues.
Thank you very much. And Governor,
can I just make it? It's a very interesting point you make about access to information. So to pick up this point that Randy made about the system-wide exercise, now we were able to do that because we have a very large concentration of financial services industry in this country. And we were able to go to the firms, and indeed the firms were actually pretty keen to sign up to this exercise. And so we did it, if you like, in a sort of hub and spokes arrangement where we were the hub and they were the spokes. And they provided us with their information. Globally, and that was very helpful to us, by the way. I mean, that allowed us to do a very comprehensive exercise, which is a world-leading exercise. Globally, we are not yet in as good a position on this front, and that's important. And so if I'm going to put my other hat on for a moment, just chair of the Global Financial Stability Board. We are doing work at the moment in that forum to seek to improve the access to data globally, because we do not have the same consistent access to data that we were able to get in this country as the Bank of England, and that is a matter of some concern. Yeah.
I'll ask potentially a stupid follow-up question, but following the financial crisis, we introduced EMIR and MiFID, and EMIR and instruments like that target information gathering for monitoring, don't you? That's one of the key policy purposes for it.
Yes.
Is it that area we need to look at updating global regulations so that you can get more information from different institutions and different types of institutions?
It can be. I mean, there's two parts to it, frankly. One is access to information, the other is sharing it. So you have situations where there is national access to information, but there are not gateways to share it internationally. Now, this is, I think, a particular issue when you're talking about the non-bank world. So let's take the hedge fund world as the most obvious case point, and it's actually also the biggest case point in this. By their very nature, of course, they are cross-border institutions. They are global institutions by the nature of what they do. So access to global information is very important. So we have a sort of slightly privileged ability to get access in the UK because we've got such a large concentration of the industry here, so we can go to them. But we need better global information on that front to complete the picture, I would say. So it is important.
Thank you very much. Lola McAvoy, MP.
Thank you, Chair. I wanted to pick up on Professor Kroszner's expertise and talk a little bit about the markets and equities at the moment. So US and global equities have bounced back from the initial tariff shock. What's your read on why that's happened?
So it's always very difficult to assess the market movements. I'll give a stab at that, but there's, as economists say, there's a wide standard error in giving and trying to explain those market movements. So I think there was a shock that came that people weren't expecting the kind of tariff proposals that the president had come up with, even though President Trump had talked about imposing tariffs. People really didn't know exactly what that would look like, and I think they were quite surprised at the extent of them, and it was both the level and the breadth of them. Now, obviously, what happened over time is that the president has proposed pushing back the date for when these would be implemented, for giving more flexibility for negotiation, and so I think that was something that was very helpful for the market to come back. Some other things that have also happened in the U.S. is the president's bill related to the budget and taxation was passed, and that has significant cuts to, or I shouldn't say significant cuts, significant extension of previous cuts to taxes on investment. And that has been very, very helpful on maintaining investment in the U.S. So my colleagues at University of Chicago and others did work on the initial Trump tax plan from the previous administration, and found the initial expensing of investment was very powerful in giving incentives for investment. And the new bill makes that permanent and reduces the uncertainty around that. So I think a combination of some of the reduction of uncertainty related to taxing of investment, I think greater clarity around the tax proposal, the tariff proposals have helped the markets to feel more confident, and also the U.S. economy has continued to be resilient. The labor market has still been fairly robust. Consumption has been fairly robust, even despite some significant initial drops in consumer confidence. The actual spending numbers have been reasonably solid.
Can I add just add one point, if you don't mind, to this? I think it's very important because there are two things going on here which sort of sit somewhat in tension. One, as Randy said, is the reaction to obviously all the news on tariffs. And the fact that equity risk premium have gone back to where they were before that news came out is a vulnerability. I think it must be clear that that looks like a very compressed risk position. On the other hand, there's this other story that, say, Randy was referring to, which is essentially, of course, particularly in the US, it's a very strong tech-led growth story. And just to give you, here's a striking fact, if you like. The market capitalization of NVIDIA is now larger than the UK's GDP. It's up 20% this year. That is a pretty striking fact. It's 7% of the overall market capitalization in the US. So you've got these two stories, these two big stories running sort of alongside each other, and in some ways in a bit of tension with each other at the moment.
Thank you. And you mentioned in your speech about obviously the global threats. That's the big concern for stability in the UK. So how do you think the falling back to April or pre-April, pre-tariff equities is going to impact us here?
Well, just to develop it, I think in terms of markets, one of the other big things that's happened is that we've had a breakdown in what I would call established correlations in markets. So that's another area where we can be quite heavily affected. What do I mean by that? So prior to all of this starting, for some time, you'd had a pretty established relationship, and here I'm talking about the correlation between bond yields, equity markets, and the dollar exchange rate, really. What we have seen since April is that correlation, those correlations have sort of essentially broken down somewhat, and the one that's particularly broken down is the dollar exchange rate. So the dollar has depreciated. So at the same time as we were just discussing the story about equity risk premia going back to where they were, the dollar has continued to depreciate. Now, I think there are two things behind that going on. One is that over time, I think longer-term investors who were typically overweight dollar assets are looking again at that and saying, we probably don't want to be so overweight as we were. And so there is, over time, this will take quite a while because these are longer-term investors, so it takes longer to work its way through the system. I think we sense, and we are told by the markets, there is rebalancing going on, which involves a reduction in exposure to dollar assets over time. And the second one is that they were also typically unhedged on their dollar positions, because actually over time it had been a pretty good trade because of this growth story that I was talking about a few minutes ago. And now we are, the message we get very clearly is that there is hedging of dollar positions going on to essentially hedge against that, what they're now seeing as a decline in the dollar exchange rate. So the most crowded trade in the market at the moment is short dollars. And that's, of course, important because 90% of FX trades have got dollars on one side of them. So that's the thing that, again, in terms of impact on the UK, we have to watch it very carefully because this is a major change in market correlations.
And so the recalibration, do you think we're finding ourselves in a new normal? How long is that likely to take? You said it's going to take quite a long time, but to get to a position of stability after these changes.
I think this will go. We'll be in this for some time for two reasons. One is because, as I said, it takes longer-term investors move more slowly because their positions move more slowly. Secondly, of course, it does depend on how the whole trade and tariff story plays out. We're not through it yet. I think that's. We don't know much for certain, but that's probably one thing we do know for certain.
Thank you, Ms McAvoy. Harriet Baldwin.
Yes, thank you very much. And Governor, I'm interested in the Financial Stability Board's view on the latest ring-fencing review. So the previous government did one under Sir Keith Skeoch, and there were some changes, and now the Chancellor's announced as part of the Leeds reforms there's going to be a further review of ring-fencing. So clearly that's something that the banks have persuaded her and the Economic Secretary is needed. You've come out very strongly in favour of the current ring-fencing regime, and I just wondered if that's the view of the whole committee. Yeah,
so I think, I'll start with a general point because I think it applies very well to this case. And it picked up things that Randy and Carolyn said earlier. There isn't a trade-off between financial stability and growth in the economy in a fundamental sense, but does that mean every one of our rules and every one of the details is perfectly formed? No, it certainly doesn't. So I was very, in a sense, supportive of Keith Skeoch's work. I thought he went into the detail of it, and there were things, as you may remember, Parliament legislated the ring fence down to a very, very great level of detail, actually. That's obviously what you can do. Were all of those details, frankly, once it got put into practice, possibly the best way to do it? No, I think Keith Skeoch pointed to some sensible things. The government wants to have a further review. We will certainly, I haven't discussed it yet, particularly with the government.
What are the red lines of the committee? Maybe
well, the red line is, look, I do think, as you said, I've said, and I have said, and I'll say again, I do think that the ring fencing regime is an important part of the structure of the banking system. I'll give you one big reason why. It makes resolution of banks if they get into trouble much easier. And it benefits particularly in terms of UK customers and UK consumers, businesses and households. So I think that is a helpful feature of it. I don't think it hinders banks fundamentally in terms of their business models. But look, again, at the margins, I'm sure there are things that can be improved, and we will work constructively to go through that process.
The view of your committees, you want it to remain in place with some tweaks. It sounds.
I think it has established itself as part of the system, and I don't think it would. To me, it would not be sensible to take it away at this point.
Kroszner, do you have a red line in this area?
No, once again, no particular red lines. I mean, what we do is we look at the cost benefits of different changes and try to see how we can achieve the resilience goals at the least cost. And so I think that's exactly what the Chancellor is trying to raise in the proposed reforms. How do we maintain stability at the least cost possible?
Wilkins, do you have a view that this should remain in place?
I think it's, for the reasons that were mentioned, it works well. I think particularly given that the UK financial system is an international center for financial institutions. To have institutions that are concentrated on the UK economy is, I think, very helpful for growth. It also is helpful for stability. When we think about those trade-offs between stability and growth, I don't think they're as big as people imagine they are. And in particular, the UK relies quite happily, I think, on a lot of foreign direct investment, a lot of investment in this country. Part of the reason is because there's faith and trust in the regulatory system, that it's going to do its job. And accidents like those that happened in 2008, 2009 really undermine that trust, and investment can go elsewhere. And so I think that this system in place has, in terms of international peers, has really reinforced confidence in the UK financial system.
Thank you, Chair.
Thank you very much, Harriet. Governor, you and the committee have wide-ranging powers in terms of recommendations, including to the Treasury. Would you be prepared to use those if you think the Treasury is going too far in its deregulatory objectives?
Well, I think we would certainly start by making our views very clear, and we'll make them clear in public, and we'll obviously make them clear to this committee if you obviously would wish us to do that. So we'll start there, I would think,
okay.
And then we'll...
Do you have, I mean, we've talked about red lines a lot today. Do you have any red lines on deregulation? Because there's a lot of, I mean, you know, the Chancellor again lent into it last week at the Mansion House, and she made a lot of quite strong views about where risk should lie, and that we're risk averse in this country. So to deregulate for that, where are your views?
Well, look, I have two very strong red lines of principle. One is, as I just said a few minutes ago, there isn't a trade-off between financial stability and growth. We've had that experience. And the second one comes out of that. Sadly, I can understand when I hear people say the financial crisis is now way in the past. We've got past that. That's all solved. That's out of the way. Move on. I suppose for those of us who are veterans of sorting the problems of that out, I think we probably all three of us in some ways were in different parts of the world. No. Yes, of course the world moves on, but yeah, that was the experience of losing financial stability, and we had a very serious recession in this country after that. And so I'm afraid I do react to people who say that, because I say, I'm sorry, this is the fundamental point about why financial stability is important. And the final point I make here, of course, is, and it goes back to one of the earlier questions, of course, success in financial stability is when nothing happens.
Yes. You've said this
so
before,
the fact that we've had market volatility this year, and we haven't had a financial stability problem, we're not worrying about banks failing, we're not worrying about market, it is of course a success. Now, it's not always easy to sort of point to it and say,
repossession is very low, yeah.
Look, you know, this is good news, but as we've pointed to, the UK banking system is very resilient, in our view.
I mean, with all these changes, and you know, we've had it repeatedly from ministers, it could make it riskier. I mean, one of the things we have to challenge the government on that. Will it mean that consumers are more at risk?
You know, the second part of my overall comment is, however, you know, as I said, yeah, are all of our rules perfectly formed? No, they're not. And by the way, there is a Brexit point here as well. I'm always careful to say I don't take sides per se on Brexit, but because quite a lot of our rule book we inherited from the European Union, from being a member of the European Union. Now, that rule, European Union rules, of course, are made for the European Union as a whole. So you get some sort of, you know, you get an averaging treatment. You get, you don't always get you don't get something that always, excuse me, precisely fits your market. So this gives us an opportunity to look at that rule book and say, you know, how do we, you know, in a sense, you know, make it a better fit for the UK, and that's a very sensible thing to do. It doesn't compromise us on financial stability in that sense.
I mean, the Chancellor has been very trenchant. You know, she talks about regulations being the boot on the neck of financial services firms. Do you agree with that?
I don't use those terms. Let me say that.
Well, so what language would you use if you were to respond to that?
It's not a term I use.
So, do you think that there is a problem with over-regulation of financial services firms?
I think, look, it's that there are areas where we clearly, you know, should look at it for reasons I've just given, and we'll look at it. We're very open to that. We've announced a whole range of things we're doing. That's a good thing. But we can't compromise on basic financial stability. That would be my overall message.
And I mean, she also talked about and compared, we've got an international panel here. You chair an international body on financial stability.
Yeah.
And the Chancellor's also said that the UK, she blames the bureaucracy, has a culture of risk aversion to the point of obsession with stamping out risk in all its forms. It's not an approach seen in any of our competitors. Do you agree with that?
Well, I would say this, that quite a bit, of course, of the core financial services regulatory is international. So Basel, of course, is global. As I said, I mean, quite a bit of our rule book across quite a large bank and non-bank world is inherited from the EU, so it's not unique to us in that sense.
And given the role of financial services in our economy and the size of it in the UK, do you think we have to play a different role now between the US and Europe? There are options there, despite the international rules that will apply.
Well, there's two things I'd say about that.
One, potential opportunity, but potentially risk.
Yeah, I mean, one I will just say, because it's a comment the IMF made some years ago about the UK, and it's right, is that the UK's financial sector is a global public good. In a sense, it's very big. We're a very big financial sector, and that's a good thing. Obviously, I'm not for a moment suggesting it's otherwise, but it does give us a responsibility globally because of that. Does it make us a sort of, in a sense, a sort of player in the middle? Well, it makes us an important player in that debate, and that's why I'm very honoured to be chairing the Financial Stability Board. It gives us a larger role in that, and we take it very seriously. Yeah. But the sort of configurations in those debates can vary sometimes. So yeah, it's not that predictable.
Okay. Well, thank you for that. For now, Dame Harriet Baldwin.
Yes, thank you very much. I wanted to move on to the subject of the implications of stable coins for financial stability. And but first I want to just talk about the bank's own project, the central bank digital currency, the Britcoin. And you spent millions developing this so far, and yet you've said publicly that you remain to be convinced of the benefits, Governor. So I just wondered, are you likely to make a go or no-go decision on this central bank digital currency for the UK? Other central banks seem to be going in that direction. The US is very clearly not. So I just wondered where your views were.
I think the ECB is the central bank that's so far been well, the Chinese have done. China's done it. ECB are more committed to it than most others, I would say. So
what are we going to do here in
the
UK? What are we going to do here in the UK?
Well, two things I'll say on that. First of all, on the spending, if you don't mind me saying so, look, we have spent money so far investigating largely the technology. I'm very pleased we've done that, because the important issue here, as I've said a number of times in public, is actually how do we get the benefits of digital technology in the payment system? Because I think there are huge benefits here in terms of smart contracts, reducing fraud, reducing cost, improving late payments for small firms, which I think by smarter payments technology, which I think could be a real benefit. So looking at spending money on the technology will pay off whichever route we go down. So that's not a regret.
When are you going to decide?
Let me come to that.
There must be a point where you make a go, no-go decision.
Well, I think sort of simplify it for a moment. The question for me is, how do we best get digital technology into the payment system? There are broadly three ways you can do it. They're not exclusive. You can do it through commercial bank accounts, payment systems, because most of our money is in commercial banks. It's commercial bank money. We could introduce retail central bank digital currency. Wholesale's a different matter. We're doing that. That's a different matter. And we could see the growth of stable coins, which is non-bank, if you like, money. My view is we need to make sure that we get this benefit through one. You may have seen what you're at the Mansion House. I think you saw what I announced last week. We are going to work with the banks in the UK and with the market to develop and, frankly, digital technology in the commercial bank payment systems, in the main payment systems of this country, particularly the faster ones. I think that's a sensible place to do it, because that's where most of our money is. My view is, if that's a success, I question why we need to introduce a new form of money.
Yeah,
now.
So you're not going to do it, are you?
Well,
that's what
we're not saying no, but what I'm saying is this: if the work with the commercial banks is successful, I would need a lot of convincing that the use case was made.
Okay, well that's really helpful, because now I'm going to turn to Professor Kroszner, because obviously in the US they've gone this week down this route, and practically everyone in the world seems to, in the US, seems to be issuing their own coin at the moment. And what implications does that have for financial stability for us here in the UK?
I'd like to be on the record that I am not planning to issue a coin.
Probably the only one I feel safe buying.
I'm one of the very few. Yes. No, so I think this is, it's very important that we finally have a clear regime in the U.S. because that was creating an enormous amount of uncertainty. Things were happening offshore, and to just have activity offshore is not good for financial stability. You want to have a good regime where people will actually use the regime, and it has to be very clear, and also has to allow for commercial viability of the institutions. And so the key provisions of the Genius Act are that the stablecoin issuers will not have access to Federal Reserve master accounts or Federal Reserve discount window. They will not have deposit insurance, but they will be able to hold high-quality liquid assets, primarily short-term U.S. Treasury securities. So they will get remuneration on their assets. They will have relatively limited interest rate risk and effectively no
This has the potential to disintermediate a lot of the U.S. banking system and potentially have an impact here in the UK as well.
So it has the potential in the U.S. What's interesting in the U.S. is some U.S. banks have become interested in potentially issuing stable coins themselves. But you're exactly right. If there's an alternative to bank deposits that is more attractive for people, that could lead to money flowing out of traditional deposits into that area. I think the banks are well aware of that. I think their voices were heard in the formation of the Genius Act, and I think they're comfortable that they'll be able to manage this. But this is something for as we consider the stablecoin regime here in the UK, to ensure that it continues to provide stability. It may provide, it can be a good source of innovation, potentially reduce costs, particularly for international transactions. But we don't want that to come at the cost of financial instability.
But I'm old enough to remember when money market funds that had $1 as the guaranteed price collapsed during the financial crisis. Stable coins seem to have the potential also to create a sort of big run on the underlying assets. And
so that's extremely important to try to think about the runs on them. And so that's one of the reasons why, at least in the U.S., the law now is that you have to hold short-term Treasury securities, so you can't be holding Lehman Brothers paper, for example, because it was the reserve fund that was holding Lehman Brothers paper. That's the fund that so-called broke the buck, because they were holding a company that obviously got into a great deal of trouble, and the net asset value fell below, sufficiently below the 1-to-1 that they had to break the buck. So this is the approach that the U.S. has taken to have that. Now, of course, you have to have very careful monitoring and disclosure around that, because you could say, yes, you're supposed to do that, but unless it's actually enforced carefully, you have to be very wary of that. The Genius Act has, I think, a fairly robust reporting and auditing regime that is part of it. But it is true that if you don't have confidence in the underlying asset that is behind this, and that there are sufficient assets there, it is subject to run risk.
So Governor, stable coins increase the risk of financial instability.
Key issue, Rand is absolutely right, is that stable coins purport to be money. Now, this is where the key feature of money here is that they have assured nominal value. Because if I'm going to use them to pay money to you, you want to know that a pound you get from me is the same as a pound you have. I mean, this is the whole point about the assurance of the value of money. And that's the test they're going to have to meet to satisfy this, and that's the test we're going to have to hold them to, because, as you say, money market funds didn't meet that test.
And do they have the potential to increase financial instability, Governor?
Well, if they don't meet that test, or if they were purported to meet that test and then failed to meet it, then the answer is yes.
And as we saw recently, the gilt market itself doesn't have perfect liquidity either. You're nodding your head vigorously, Ms. Wilkins. So.
Yes, yes. I feel really strongly about this, because if it's if it's a systemically important stable coin, so it's kind of the backbone of payments in the UK or anywhere, it has to be able to hold its value. And it's not just about the backing assets, it's about the capital it holds for, and liquidity it holds for operational issues, for short-term liquidity needs. And it's about the consumer protection, fraud, AML, all that kind of stuff. And so the challenge for the UK that we're working through is how do we have a regime that is safe, that provides all those protections, so it serves the UK well, but at the same time is compatible enough with the US regime and the regime in the EU. And so because you have to have a business model that's viable in some sense, but safe. And so that's the work that we're doing. I think the discussion paper that was put out, that we got lots of useful comments, and we're thinking those through, and I think there's going to be a lot of interesting discussions coming up on that. I think it sounds like I'm really negative on stablecoins. I'm not. I just feel that if we're going to have the potential, particularly in cross-border payments or in just retail payments, they have to be properly regulated.
Simple question for you, which all three of you, which is a yes/no answer, please, because you are the Financial Stability Board. We are we put our trust in you keeping things stable. So do stable coins make the financial markets more stable or less stable? Or do they, yes or no, I'm going to say, do they make them less stable, Ms. Wilkins? Just a yes or no.
As they're regulated
Just
now,
a yes or no.
then the answer.
Well, they can do.
They can do, yes. They can do.
Yes.
Yeah.
That's
There's a long way to go before they can.
But without regulation, no.
I mean, the key thing is, one of the big reasons we regulate banks and the bank system is the value of money. It's this assurance over the value of money. So a pound in my bank account is assured to be the same as a pound in your bank account. And they're going to have to meet that test. Otherwise, and that's, if they do, the answer to your question is yes. If they don't, the answer to your question is no.
Exactly, I would agree. It really depends on the regulatory structure, and I think that's true. That's true of money market funds. It's true of deposit accounts at banks. It really is the appropriate regulatory structure.
Well, I'm sure it's a subject we'll come back to, Chair.
Thank you very much. Lolo McAvoy, MP.
Thank you, Chair. So, Governor, we just heard that obviously the fact that we haven't had a massive recession as a result of the global instability is a success story for the country. But in Darlington, people are still struggling with the cost of living, and things feel pretty tough out there in all of our constituencies for ordinary working people. In terms of the changes to mortgages, we've seen that the individual lenders will be able to exceed the existing limit on the loan-to-income ratios. And I suppose I'm just wondering, is this the biggest tool we've got to make sure that ordinary people can get a foot on the ladder in terms of buying houses, or is it a very small change?
It's important. It's the thing that we can do. Where I would qualify it is by saying that when we ask people what are the impediments, and particularly for first-time buyers, when we ask them what are the impediments, the answer that scores largest in that question is access to the deposit, not cost of servicing the debt. And we don't have the tool to address that question. So I think that's an important caveat to add, that this question of access to the deposit doesn't get addressed by us changing the way in which we configure the LTI scheme. But I do think we set the 15% limit a decade ago as an aggregate limit because it's a macro policy. It was designed to say there's a certain level in the economy as a whole above which, looking in the past, it has contributed, to economic instability. Now, we've actually never seen the full 15% used because it's a macro policy which, when it gets applied at the micro level, firm by firm, they don't all use it. Currently, it's about 9.7%, I think, is relative to 15. So I think this change, we've made a few changes over the years. I think this one really has the potential to push that number up. But I come back to my caveat. This question of access to the deposit will, of course, still be very important for first-time buyers.
In terms of the 15% aggregate limit, obviously, if people are using 2/3 of it, do we think, is it enough of a change to get this actually felt by constituents? in Darlington, or is it I suppose what I'm trying to get at is when we were looking into it, it sounded fantastic that more people are going to have access to mortgages, but then when we looked into the detail, it seemed like such a tiny change that each firm is going to be responsible for their own individual increases, and they only have a risk appetite of 9.7%, not even 14%. So what's your read on how this will actually shift the market?
Well, we've had large lenders come to us and say that if we were to raise the individual, the application of this 15% at the individual level, they would do quite a bit more. We've already had 2 applications in the last week because we've changed it immediately. I expect more, by the way. So I do think it'll make a difference. But look, there are quite a lot of lenders whose business models are not to be large in this market. You know, they're not focused on the high LTI end of the market. They're not going to change because, I mean, that's their business model. So I don't expect every firm to come along to us and say, we're going for it. But I do think it'll make a difference. Yeah.
Okay, thank you. And Ms. Wilkins, you mentioned it in your opening remarks about these changes. What do you think are going to be the actual material impact and how quickly? Obviously, the Governor's just said that 2 firms have already applied. How quickly do you think we're going to see changes on the ground for this?
Well, that's going to be up to the PRA and how they implement it, but what we've been told is exactly what you just heard, is that it's effective immediately, there's appetite, and so what the PRA can do is approve those numbers, but then it's up to the financial institutions to extend the mortgages. And I don't know about their timing, but certainly when you look at the data, first-time home buyers are already a big share of the flow of new mortgages, and this will only add to that. So.
Okay, and I suppose the only other thing was just about changing the 15%. Is that on the cards? So moving that to a wider share, would that not have been a quicker way to get mortgages out? Well,
I think, given we've got so much headroom between 9.7 and 15, I think actually utilising that headroom is the sensible thing to do. First of all, I see the 15 was we went through a decade ago, and we've actually reviewed it a lot of times over the last decade, and that's a macro point about the consequences of of a downturn in the economy. So there was a reason for the 15. What I'd like to see us obviously is get up to get much further up towards the 15, because that would make a real difference. I mean, literally it would. I'm not suggesting that this will happen, because there will be reasons why not everybody will do it, and it won't be used to the full. But if you ask me a question, well, if the overall number went up to 15, how many more first-time buyers would that be a year? It's about 36,000.
Okay,
that's not small.
Thank you very much, Ms. McAvoy. James Siobhan.
Sorry?
Except. Wouldn't it have been a lot more, a lot clearer, a lot more understandable, a lot more encouraging if you did set a higher limit, if you went up to 20%? Talking to the building societies, as we recently have, who are very sensible lenders, who have a social mission to be of assistance to their members, and particularly to first-time buyers, they've told me that they wanted to see a limit of 20% because they wanted to be able to help more first-time buyers. So why not just make it a lot clearer?
Well, they can get to 20%, but they can get to 20% now. I mean, essentially the headroom is there. If they want to go to 20%, and they've convinced us that's sensible to do, they can do it.
Just made it a lot more complicated.
No, it's actually very simple. We've actually changed the policy overnight and said, all you need to do, send us an email, ask for what we call a modification by waiver. It's yours. One of them has already been through the process. So what are we, week on? Another one is going through the process. I know several more are going to put their emails in any day. So this is really very simple.
I met with my favourite building society a few weeks ago, the Skipton Building Society, right. And they're my favourite because they come up with models of mortgages that have, that are about where first-time buyers are at. And many of these potential first-time buyers pay huge amounts of rent, yes, and pay their rent on time.
Indeed.
And are good risks, but they can't borrow enough in order to get a mortgage. And so Skipton were really looking at them. So the increasing, and as were other building societies, I suppose I shouldn't have a favourite, but they are sensible lenders, keen to help. Yeah. Would it not have helped them more just to go to that limit, or do you think that they will be the sector that will go to you and say, please let us do this.
I think the building society sector will be active in this front, because I have the same conversations with them that you do, actually. So I'm expecting them to be quite leaders in this. So I would encourage all your favourite building societies to send us emails.
Yeah, because, you know, we have to do something, don't we, to help this group of people who are great at paying their rent and who have huge rents to pay, but aren't building up, buying their own home and doing what we'd like to see everybody have.
I think there's a second point there which you rightly refer to, which is a slightly different one, which we also think is important, which is how lenders, or prospective lenders, can take into account and ensure they've got the evidence to say that the person has actually had a good record of paying their rent, which can actually contribute to their credit record. Yeah.
Thank you. Thank you, Dame Siobhan. Lola McAvoy, please.
Thank you, Chair. Actually, my question was just going to ask you that about how can people who are clearly... Do you want to elaborate a little bit more on that? Because I'm interested in the 4.5% element, because... Sorry, 4.5 times your earnings, because obviously people are paying some people are paying double that in their rent. So I just wondered if
I think most lenders, of course, will have an internal limit as to that it may well be higher than 4.5, but they will have an internal limit where they don't feel comfortable going above. I mean, that's the case. I think Dame Siobhan's question was actually about, and I think it's an important one, which is we have been discussing with the lenders, is where the person has been in the rental markets but has established a good record of obviously paying their rent on time and in full, how can that get translated into their credit standing? That's an important question as well.
Could I just say, you know, don't the way caps or limits work is that most organisations will try and come in under the cap. So that they will, they know the cap's 15%. You know, if you come in at 12.5 or 12, you're safe, you're not exceeding it. So keeping that cap of 15%, even if it's an overall and it can vary, will that just not liberate some of those organisations?
I think the difference there is that the 15 is a sort of overall cap. We're now, and yes, up till now we've applied the 15 then down to the level of the firm. We're now saying to them, look, you can come to us and go above 15. And if you want to build a margin in, well, okay, you can do that. But you can go higher.
And what's going to be the watermark for that? So if everybody, following this, I'm sure it's, you know, lots of people are watching at home. If every firm tomorrow,
I'm not sure.
if every firm tomorrow
carried away.
Puts in an application, you know, what's the saturation in the market for going above the 15 that you think? What's your
well, we can obviously see the whole market. We can add the numbers up. We would look at it as to where it is relative to the aggregate 15, but it's got a long way to go before we get to that point.
Thank you very much indeed. John McGrady.
Okay, well, quick follow-up on the housing, if I may. Just at page 41 of your report, it points out that bank staff analysis suggests that unless there's an increase in housing supply, what these sorts of reforms can do is simply involve more money chasing the same number of properties.
Yes.
And that equals house price inflation, which inevitably is followed by a house price crash, as we saw after the Lawson boom, after we saw after the global financial crisis. So how important is it, Ms. Wilkins, that the government pursues policies to increase the supply of housing?
I think it's very important. I mean, I do think it's important. We have said for quite a long time that in our view the major constraint in this area was the supply of housing, not mortgages.
And Ms. Wilkins?
And I think that continues to be the case.
I would echo that, and I would say that that's not just true in the UK, that's true in Canada, that's true in Sweden, it's true in Australia. You can't get around the supply issue, and when you have, you know, the price of housing relative to income, that ratio so high, there's no way around it. There's no reduction in regulation that's going to solve that problem. It's going to be about the supply of housing, and it's going to be about sustainable growth and incomes.
The biggest problem here is we're not building enough houses and increasing the supply. It's what I'm taking from both the Governor and Ms. Wilkins. Professor Kroszner, are you in the same boat?
Yes, I would agree, and it is also an issue in the U.S. of one of the key things is housing supply in particular areas. Chicago is where I'm from, has relatively low housing prices, in part because of the geography. It's very flat in the Midwest, and so it's very easy to continue to build houses. In many other areas, zoning makes it extraordinarily difficult because of either particularities in the area or the particularities of geography. And so that is a very, very important issue, and one that I think countries are struggling with globally.
Thank you very much. Now, if I may, Governor, I'd like to move on to pensions reforms. And we were discussing the pensions bill in the House. It had its second reading, I think, last Monday. Now, Governor, you've intervened and expressed a lack of support for the backstop power in the bill to mandate certain classes of DC funds to invest a certain amount of assets in private assets and some of those investments to be in the United Kingdom. Could you talk us through your concern?
Well, the question I was asked was actually about mandating. It wasn't about a particular form of it. Look, can I start by saying I am a very strong supporter of the pension reforms, and not just because it wasn't just this previous government had very similar intentions as well, so I don't think there's much distinction there. I do think it's essential. I think it's essential to the rate of investment in this country, which we need to raise growth and raise supply side growth. And we do have, I think, a too fragmented pension fund system, which makes it harder to manage risky assets. So I'm very strongly in favour of these reforms. I would also say, and I think the government understands this very well, that there is a lot of heavy lifting involved in actually doing these reforms. It's not something that I'm afraid will happen overnight. The point about mandating, I do think that it's important that we let investment markets work. So I do think that mandating could, it could have unforeseen consequences, which do make me nervous. However, let me give the other side of the point, which is, if, as I hope, we go down this road of pension reform and it doesn't happen, then I think there is a very strong moral suasion point on industry to do this. I don't for a moment want to see a situation where we go through these reforms and it doesn't happen. But yes, I mean, personally, I do believe in markets, and I am nervous about unforeseen consequences of mandating. That's my concern.
Are there any foreseen consequences that make you nervous, Governor?
Of mandating?
Yes.
Well, obviously, I mean, if it worked seamlessly, it would deliver the result. But I think there are potential unforeseen outcomes where it could go in other directions. I mean, the question about would you go down to the level of saying, well, what do you mandate the investment in? I mean, how micro and detailed is this going to become?
And on the flip side, the draft legislation contains a reserve power, which is quite specific to mandate. Do your concerns apply to that reserve power as well?
Well, a lot would depend, I suppose, on how it was used, to be honest. Again, I hope that we can generate a market mechanism that produces the outcomes we want, because I think that's a much better place to be. I hope it would create all the right incentives for pension fund investment. It does in other countries. I mean, Carolyn's much better to talk about Canada than I am, but Canada has a very different pension system which does generate different outcomes.
Would you have anything to add, Ms. Wilkins?
I would say that the pension funds have a fiduciary duty with respect to their pensioners, and thinking through what's the right investments to give the value there, and if there's anything about a mandate or a reserve power that would direct funds in a way that wasn't in line with that would be problematic. And I'm not questioning the pension reform or anything in the UK. It's just a fact about markets and how they work. In Canada, there's also been discussion about how much Canadian pension funds invest in Canada, and lamenting that
you're hearing about how much they're investing here. Yeah.
But boy, do they invest in the UK. And I think if, from an economist's point of view and a policymaker's point of view, I think, what is it about the environment that would attract more investment of pension funds without telling them that they need to do it? So what is getting in the way? And that's the exercise that's happening in Canada. And then you've got an even better outcome. You've improved the investment environment, not just for pension funds, but for everyone. and again, you're allowing the market to work.
So on that, am I right, first of all, just quick yes, no, that Canada doesn't have mandation? Does Canada have mandation?
The Canadian pension fund does. There is some, in Quebec, there's some public-private collaboration with respect to the Caisse de dépôt, but in general, no, not with respect to the Canada Pension Plan.
So the point you're making, Ms. Wilkins, points to the fact that actually in the United Kingdom we need to create investable propositions so that people can invest in them, and then the rest will follow.
Well, and also have a pension fund system that can efficiently make the investment,
Yes.
which I don't think we do today.
Yeah. Sorry, Ms. Wilkins.
Yes, I guess you wanted a yes or no, and that last statement was a yes. And there's some good starting points because, like I said, there's a lot of investment in the UK on the part of Canadian firms, not just pension funds.
Now, one area of potential growth and investment for pension funds, particularly the bigger pools, because they can invest in a wider class of assets, is SMEs. And the report's very interesting on this. What it points out at page 52 is around 80% of SMEs are not seeking access to external finance in 2024. And the stock of SME debt as a share of UK GDP has fallen over the last 15 years from about 13% to 8% in about 3 years. Now, we had Mr. Flint from a National Wealth Fund speaking to us a couple of weeks ago. He expressed a real concern that financial institutions in Britain aren't taking on enough risk, and it was in the context of this sort of discussion. Are you concerned, Governor, that financial institutions aren't investing enough and taking enough risk in lending to and supporting SMEs?
Well, we are doing work and we will be reporting on this in the next FSR, so that's in the fourth quarter, and we'll certainly happy to come and ask questions on it at the next one of these hearings, I'm sure, on particularly financing of growth for SMEs with high potential growth rates, because we think that's an important area. So many SMEs, of course, actually don't want outside financing, and that's a choice they make. But you're right to point to the fact, and we point to the fact in the report that the share of SME debt has declined. I mean, there were bad experiences during the period around the financial crisis. I've still got scars from dealing with quite a few of them at the FCA. And I think that did have an effect. So I do think we need to be very clear on what the sort of, in a sense, the structure of lending is, particularly including from the banking system, by the way. Because I do think that raising access to financing for SMEs is important. So that's one thing we will be reporting on, and we've said to the government we'll do this as part of our remit, and we'll be happy to come back to you on that.
And is the review going to look at things like the banks insisting on security over homes and things like that? Because I think that's one thing that SMEs would say is that you go to the banks to borrow and you've got to give us security over pretty much everything.
Well, I think we'll look at all aspects of this question, particularly the high growth potential SMEs, so we won't rule anything out in that sense as to how it works.
That's enough for me. Thank you, Dame Meg. Thank you.
Thank you, Chair. Mr. Kroszner, you recently gave a speech about the interaction of financial stability policy and monetary policy. And in the area of quantitative tightening, this has been a topic of hot debate. Do you see any liquidity issues or financial stability issues from the pace of QT?
And so I think it's certainly very important that we do monitor exactly those issues. We talk with the Monetary Policy Committee about the choices that they make on the pace of quantitative tightening. And when there had been a concern about a sale in April, they postponed that sale. So I think there's a very clear interaction between the Financial Policy Committee and the Monetary Policy Committee to try to assure that as the bank reduces the size of its portfolio, it minimizes the chance for risks in those markets.
Can I just say for the record that the postponed sale happened yesterday, so that's done. Sorry for that.
Thank you, Mr. Bailey. And Mr. Kroszner, you described the postponed sale and the decisions that were made then. From my understanding, that's a Monetary Policy Committee decision. What's the kind of feed-in that external members or members of the Financial Policy Committee who are not on the MPC get in those decisions?
So we meet regularly with the Monetary Policy Committee. We also get a number of briefings that the Monetary Policy Committee receive about the macro situation and macro risks that they see, because obviously that's something that's very important for the Financial Policy Committee members to have. And so I think there's a very good, robust discussion that occurs on these things, but clearly the ultimate governance of that is something that's controlled by the Monetary Policy Committee. But there's a very good interaction, and I think our concerns and issues are taken very seriously by the Monetary Policy Committee.
And I'm really curious about the governance issues which you explored in your speech, given that the statutes give a lot of space for interpretation and for the bank to decide how exactly to do that coordination between the two committees. Is there anything you think could be clarified or improved about that coordination?
As you could see from my speech, I was very positively disposed towards the structure that the Bank of England has of having a formal Monetary Policy Committee and a Financial Policy Committee, both chaired by the governor. We don't have something like that in the United States, and so in some sense, part of my speech was suggesting that as the U.S. is thinking about reforming its central bank strategies, that it should think about integrating some of these ideas in, be much more explicit about integrating in the role of financial stability in thinking about monetary policy. One of the things that I think works extremely well here is that the stress tests that are undertaken are largely driven by the Financial Policy Committee. And so the governance of the stress test is under the Financial Policy Committee. And one of the things that the Financial Policy Committee did before I got here, so I get no credit for this, is to say one of the big potential risks coming up was that interest rates might go up very substantially. In the U.S., they didn't do that as a stress test. And so I think that was a very sensible thing to do that came out of the particular governance structure that is here at the Bank of England, that I think something like the Federal Reserve should consider, not the exact same structure, but integrating those sorts of ideas in, and in particular, thinking about financial stability issues when thinking about their stress tests.
So just to clarify, in, for example, the August report that on quantitative tightening that is coming up, will non-MPC members of the FPC have any formal feed-in or any way of influencing that report?
I'll leave that to
I'll leave that to
the governor.
The governor, yeah.
Governor.
Yes, we will invite feed-in. We're at the early stages of that process at the moment.
And what does that look like in terms of the coordination between the two sides of those committees?
Well, I think it goes back to what Randy was saying, that that there is interaction between the committees. We will offer the FPC the chance to express views. That's the way we usually do it.
Yeah. See, it seems to me that the previously in MPC meetings that we've had at the Treasury Committee, we've explored the impact of QT on, of course, the short end of the yield curve, which is of interest to monetary policy transmission. And then there is another side of the conversation, of course, about the long end of the yield curve, and that conversation isn't in the room with us when we talk about the topic. So I wonder if you think that there is any disadvantaging of having the quantitative tightening decisions be a solely MPC decision?
Well, I mean, there are three principles that we've set out publicly to sort of, in a sense, guide how we go about the decisions. And the way I would characterize them is principle one really is about the monetary effects of quantitative tightening. Principle two is about market functioning, which would include financial stability. Third one is actually, it's more of a sort of, I'm not sure it's a principle, but it says, we will do it in a gradual and predictable fashion. And those are the three things that we hold to. And so we set the whole process up to, in a sense, answer the questions every year around those principles.
Is there a risk that if the MPC members who are making decisions on QT are primarily considering the short end of the yield curve, that the impact on long-term maturities is not sufficiently taken into account?
Well, I mean, speaking as, of course, as Randy was saying, as someone who's on or chairs both of the committees, I mean, that's my job and job of my executive colleagues to ensure that actually that doesn't happen. By the way, I please don't characterise the MPC members as, in any sense, being short-sighted in that respect. I don't find them so at all.
No. It's a matter of different hats for different
Yes,
situations.
yes.
And some of you are wearing overlapping hats.
Yeah,
so
I mean, I think that's why the principles are helpful.
Many hats of the governor.
Many hats, yeah.
Got more hats
Yeah.
than I can count. But one of the things I find helpful chairing the process is to say, look, we need to make sure we go through each of these principles and do them properly.
Yeah.
Yes.
And in our previous committee hearing, I think Dame Harriet raised the question of the analysis the bank had been doing on the impact
Yes.
of QT on the long end of the yield curve. There have been calls from investors recently and market participants recently in the FT for the bank to slow the pace for
Yes.
financial stability reasons. I was wondering how your analysis has evolved over time on that question.
Well, I'm not going to, if you don't mind, because we're actually, we're now in the process. So obviously, I'm not going to comment on a live process. But again, going back to things I've said recently, and indeed the first question that the chair asked me, is that we obviously, the staff in doing their analysis, look very carefully at what is driving those yield curve movements. Now, by the way, I do not think it's QT that's driving those yield curve movements, as we were saying in the first question. I think it's other things that are doing. But I've said a number of times, and I'm happy to say it again, of course we do need to look, however, at the interaction of those yield curve movements with the QT programme and with market functioning and with monetary policy impact, and that's what we're doing.
Ms. Wilkins, I was wondering if you had any views to add on the interaction of QT and the impact on the long end of the gilt curve.
So having been part of the discussions on the previous decisions, I'm not going to comment on any upcoming decisions. I think the process works well. We have the opportunity to comment and very productive discussions. I think that it's important that we do get that opportunity for sure. The analysis that's been done that the governor just talked about with respect to global factors being the main driver, QT is not really what's driving the yields in a major way at this time. Yeah. I agree with that analysis.
And finally, Governor, you mentioned the April gilt sale that was postponed, and that happened yesterday, you mentioned. Can you tell us a bit about the decision-making behind the postponement and also when to reschedule it, and who makes those decisions?
So the decisions are made by the executive. I mean, frankly, the April decision, there was too much volatility in markets at that time. I mean, bear in mind that we were in the middle of all the trade policy uncertainty at that point. My judgment of my colleagues was that was not a wise time to do that auction. I think that was the right decision.
You have to liaise with the DMO to make sure.
Sorry,
you have to liaise with the DMO. So
yes, of course, yeah.
So that will limit when you can reschedule.
We told them that was our intention, and we sort of said, do you agree? And I think they'd be happy for me to say I don't think that they were likely to disagree with that judgment. Frankly, the decision yesterday was again a decision by the executive. We took the view that markets are calmer now, and I think that was borne out by the outcome.
Thank you very much, Ms. Jan. Dr. Jeevan-Sandra, MP.
Thank you very much, Chair. I was going to go on about some of the action around the Bank of England and how it may be affecting financial stability, rather. But first, I want to ask, do you think it's important that governments have fiscal space in order to combat financial instability? So, for example, the energy price shock that we had, the government, if you like, intervened in energy markets to ensure there was a guarantee. That stopped households going under. That stopped, if you like, loans getting called in. So it helped to promote financial stability in that way. So do you think in that sense? So I want to pick up then on the pace of QT, particularly its impact on fiscal space. What do you think the impact of QT has been on fiscal space? What do you say to those who say the impact of QT or the effects of QT have been far too quick?
Well, I think I copied to you the rather long letter that I wrote to Richard Tice on this subject. So I hope it was helpful for me to do that, because I went into this issue in some detail in that letter to really get some of the sort of facts on the table, which I thought was useful. I hope it was useful anyway. As I said in the letter, there are really two ways to look at this question in broad terms, but obviously you're focusing on the second of those, which is fair enough. The first one is what I would call an overall economic cost-benefit analysis, and that would require us to sort of model the counterfactuals of what would have happened if we hadn't done QE. Put that to one side. We're talking here about what I would call the cost of debt servicing, the cost of government debt servicing as the appropriate lens for these purposes. And that's the right way to look at it, I think, and it's the way that I think public accounts look at it, which is what is the effect on the cost of government debt servicing of QE and then QT. And as I said in the letter, it's obviously it's quite a complex area, but look, broadly, obviously QE takes a set of bonds that have got fixed interest costs and turns them into a variable interest cost based on bank rate. That's the way to look at it. Now, obviously, while interest rates were going down during the decade after or more after the financial crisis, that generated a cash flow, a positive cash flow. When interest rates start to go up, that cash flow goes into reverse. That's a point we've been making since the start of this whole process back in 2009. The important point I added in that letter was to say, you've then got to look at it as a counterfactual, which is to say, the UK historically has issued far more debt at longer term than other countries, other major countries, which is, by the way, quite a good policy in many ways. That means that the UK was able to cut its cost of borrowing, looking out into the future quite a long way, by issuing more long-term government debt when interest rates were very low and when the yield curve was low. Now, that's a benefit, if you like, in those terms of both us cutting interest rates down to nearly zero and QE flattening the yield curve at that point. When you do QT, obviously that does go into reverse. The question is, how much of that benefit do you give up and how much of the benefit have you retained? And we're going to try and do some numbers on that, see if we can illustrate it, because it does require quite a lot of assumptions, but we'll see if we can do that, because the reason I set this out is that the benefits of this in the cash flow of government debt servicing, in the point you made, are not quite what they seem in that sense, because there is a locked-in benefit that the government got from issuing long-term debt in the past at very low interest rates. And I accept that some of that has been given up, but actually the UK government still has a longer-term debt maturity than other countries, even after QE is taken into account. So I think there is still a benefit in there, and we'll have a go at trying to put some numbers on that.
I take the point, right, which is you bought along the curve, if you like, and actually from
well, that was deliberate from the start.
And I do understand. The question is really on the pace of QT and the impact that it's having on fiscal space, then on financial stability. So to go back to some of the stuff that my colleague Ms. Yang was referring to, the postponing of the auction of long-dated gilts earlier this year suggests that implicitly there's a recognition of the fact that the pace of QT is affecting, if you like, is affecting government borrowing costs and therefore might need to be adjusted. I'm seeing estimates.
No, it's market conditions.
We just heard that very clearly.
So but the market conditions, of course, are around long-term borrowing costs for the government and the impacts they have on the financial stability of the government, right? Because the idea is the bond rate goes up too high, it's impacting all kinds of financial stability, which goes back to the point about fiscal space. And so my question is that do you therefore think this does have some kind of implication around QT in the pace?
I mean, this is really not a question, I'll have a go at answering it, but it's much more of a question you should ask to the OBR or the Treasury. But as I understand it at the moment, if you put it very much literally in the context of the fiscal rules, then because the two fiscal rules, one of them is biting, the logic, if you were actually making the decisions purely on biting fiscal rules, is actually that we should sell more. And the reason for that is that there's a difference. There's two ways this cost can come through. One is through the cost of selling immediately, so that's obviously a discount on the sale price. The other is if you don't sell, you get it through the cost of carry because of the higher interest rate. So we're paying more interest rate out at the moment than we're receiving. And as I understand the fiscal rules, but you should really ask the experts on this, the biting fiscal rule at the moment would indicate that the better thing to do would be to sell more rather than to take the cost of carry over the long term. Now, to be very clear though, however, we take decisions not from that point of view, so that's not a motivator.
Fiscal rules are for the Chancellor.
Since you asked about the fiscal rule, I would just make that point, that it's not actually if you follow that line of argument, you don't end up in that place.
I'm not sure I did refer to the fiscal cost. For me, it's the total fiscal cost. But my concern is basically around...
I'm making a point about total fiscal cost.
My concern is around the way the fiscal cost is impacting financial stability. And I appreciate through, if you like, a secondary or rather a continuing channel of events, for example. So, for example, at the moment for QT for this country, There's estimates that here it will cost around 5% of GDP overall. In the GDP of the US, the cost will be out 1.5%. The ECB at 3%. I mean, fiscal space is important, I think, to some extent for financial stability. Do these considerations have an impact on the pace of QT options?
Can I just make the point again that those numbers that you've just quoted do not take into account the point I just made. The US, Randy's expert on this, the US, because of the maturity of the US public debt stock, which is much shorter than the UK public debt stock, bought much shorter debt. The UK has a much longer public debt stock. So right from the start, I think rightly the Bank of England said, we do not want to distort the gilt market, so we will buy basically equally weighted buckets of the maturities, because that's the way not to distort the market, which is important. But the benefit that isn't in those numbers you count is the fact that the government has been able to issue a lot more longer-term debt at low interest rates. Now, as I said, QE and QT take some of that back, but they don't take all of it back by any means, which is the point I made in the letter to Richard Tice. And those numbers that you have do not take that into consideration.
Around the pace of QT. Can I also go back to some of the letters you wrote earlier around financial stability? So you wrote to the committee in April and in May of this year. And a letter to the committee you spoke, and you said, Randall wrote, introducing minimum reserve requirements could reduce the bank's ability to utilise their liquidity buffers during stress, which is counter to our financial stability objective.
Yes.
First, my question is that if that was the case and there was a minimum reserve requirement of 1 or 3%, do you think the bank would still have, if you like, 97% of their reserves they could use to, in a liquidity crisis, to help promote financial stability?
Well, this is the first half of the letter to Richard Tice, actually, this point, and I made the point that we are essentially moving to a policy where we meet the banking system's demand for reserves. But as we go into that policy, and that will happen as QE unwinds and QT does that, obviously if you change the terms on which the reserves are provided, then the banks will not demand those reserves, and that's the point I made in the letter, that actually to try and count the fiscal benefit of that would be illusory. Now, what I also said in the letter, and I think this is your point, is of course you could say we're going to mandate a slice of reserves. The ECB did this a bit for a historic reason, that historically they had a small slice that was a minimum reserve requirement, which was in history. We don't have that in history, by the way, in our system. It's a very, very small slice, so it's a very small slice. But the point I made in the letter to Richard Tice is that if that was the case, if you lock reserves in and say you've got to maintain non-interest-bearing reserves at the Bank of England, we can't count those in the liquidity buffers because obviously they're not available because it's a mandated piece of reserves.
It is, but I'm trying to get to the point. I mean, first of all, I think we might have had minimum reserves in the 1970s, but your monetary history
in the 1970s,
but
we don't have them now.
Certainly not unprecedented in British history. I think I'm trying to get to is, I suppose I'm slightly confused as to how having a minimum reserve requirement would reduce the liquidity buffer when it's such a low...
Because it's not usable.
But it's such a low percentage of reserves. You still have 95% of your reserves that you'd be able to use as a bank.
Okay, but then can I please... I mean, that sometimes gets banded as a big fiscal benefit, but it isn't because it's so small.
That isn't my question, though, is it? My question's around the rest of the able to use. But on that note, I'm happy to actually leave it there.
Well, we've also got, remember, we have the governor in front of us on monetary policy in the autumn, so we can, that's perhaps more.
There's no escape from a poor governor.
But can I thank our witnesses very much indeed for their time. I hope you get a bit of a break over the summer, Governor, before you're in front of us again. Not too soon for us, but.
What a monetary policy to do first, mind you.
But we have an interesting session where we discussed the rising cost of government borrowing, which the governor made clear is part of a global trend. We had a good discussion about mortgage lending and hearing that there's a keen appetite from some lenders swiftly getting onto the bank to extend their lending envelope. And we explored how Financial Policy Committee members view the relationship between financial stability, regulation and growth, and had a good discussion about that, hearing that you didn't feel it was a trade-off between growth and regulation, which is interesting and something we continue to lean into as a committee. And we had very serious conversation about stable coins and the concerns raised about that, and that they will only work with very firm regulation. I think that pound in my bank account and pound in your bank account point was very well made, if I may say, Governor. But can I thank you very much indeed for your time. The transcript, thanks to our colleagues at Hansard, will be on the website uncorrected in the next couple of days. And thank you to our colleagues at Bowtie for their broadcasting. Thank you very much indeed.
Thank you.
Order.
Thank you.
Thank you.
Order.